GetCRACK. Wake up, motherfucker.
Dude, I want you to be as smart as I am.
Motherfucker, give me a...
Dude, I want you to be as smart as I am.
Motherfucker, give me a...
Dude, I want you to be as smart as I am.
Motherfucker, give me a...
Dude, I want you to be as smart as I am.
Motherfucker, give me a specific...
Dude, I want you to be as smart as I am.
Motherfucker...
Come on out, you rapist! Dude, I want you to be as smart as I am.
Fall is here and winter is coming, and you need to shop Lowe's Customs. For the ladies, there's stunning designs and colors. For the men, Lowe can make something manly to keep your insecurities in check. But wait, there's more. For you simps, there's a special Simp Edition, where Lowe will roll around in it, blow smoke from the finest Southern Eastern American marijuana. She'll even rub her pretty feet all over it just for you. So what are you waiting for? Shop Lowe's Customs now, exclusively on the John Galt Urban Landlord channel. Let Lowe help you stay cozy and warm this season. Shop Lowe's Customs today.
GetCRACK. Wake up, motherfucker.
There's a new hit podcast taking X and tech world by storm. It's called Google Deep Dive. It's taking on everything from the latest in science to classical literature. The only catch, the hosts aren't real, and the producer is you. This is all part of Google's new Notebook LM project. And Deirdre Bosa has more in today's Tech Check. Hi, Dee.
Morgan, I hope you're intrigued because instead of telling you about this new tool, I'm going to show it to you. Now, earlier in the show, I heard that you guys were talking about that JP Morgan iPhone survey. Here's another version of that in podcast form with two AI-generated podcasters. Have a listen.
Get this, we're diving deep into iPhone territory today, but not just any iPhone chit-chat.
Right.
We're talking about why people are really shelling out for those new Apple phones. Luckily, we've got some clues to work with. We've got this juicy JP Morgan survey.
Yeah.
Over 500 people gave their insights on smartphones and buying decisions.
That's a pretty good sample size, actually.
Yeah, it gives us a good snapshot of what's really going on.
I mean, I don't know about you guys, but this blew my mind. This is all AI generated, and it sounds pretty close to how someone might expect Carl and I or Carl and Morgan to sound on a podcast breaking down that JP Morgan survey, right down to the uh-huhs and the banter. It's worth the full 10-minute listen, which we'll post. Now, analyst notes one useful example for our audience, but Notebook LM is billed more broadly as a personal AI research assistant. Students are using it to make their textbooks into more engaging podcasts. Lawyers can upload legal briefs, scientists with lab notes and research papers. This is powered by Google's most advanced AI model, Gemini 1.5 Pro. And judging by the reactions to it, including my own and the Tech Check teams and the broader tech community on X, this could be the next killer app in generative AI. Now, the next big thing in Gen AI has been multimodal capability, or the ability to process and understand multiple types of input and output, like text, images, video, audio, even sensory data. Audio in particular, guys, is proving a competitive battleground with Meta's celebrity voice chat bots, OpenAI's advanced voice mode that was outlined at Developer Day earlier this week, and Apple and Amazon's promises for better voice assistants, Siri and Alexa. Google, though, may just have the viral moment here with this Notebook LM multimodal capability plus a killer use case. Now, its product lead posted this meme saying, "Our TPUs right now" on X just a few days ago, suggesting that all of this attention has strained Google's AI chip infrastructure. And keep in mind, guys, that this is still in labs, aka Google's beta or experimental mode, as Google tends to do. As we know, though, the space and technology, it moves incredibly fast. OpenAI's billions in new capital. That will make sure that it stays that way, and they'll have a competitor. And you might just think, finally, that this is podcasts and maybe gimmicky, but that's like saying ChatGPT was just a chatbot. Some of the biggest platform shifts are driven by consumer adoption and sets the stage for enterprises to pick up. And this podcast, a good example of what Gen AI can do.
I have so many questions. I have so many.
Yay.
And I will definitely listen to the full thing here. As a podcaster myself, I'm really curious how this is going to shake out. But the voices themselves, I just want to go back to that, because there's already been this sort of sticky issue of, you know, who owns the voices, yes, where the voices are coming from. We know FTC is looking at stuff like this right now. I just wonder how that's factoring in here.
Right, so you can sort of generate or build totally unique voices, but if you want, say, a John Cena or a Judi Dench, like Meta does, you license it, right? And so this whole licensing issue is becoming so interesting in generative AI. In this case, for Notebook LM, you actually upload the documents yourself. You can upload text from a web page. You can't go past paywalls, but you can upload up to, I believe, 50 different documents or audio pieces to give you something. So it also says that they don't share it, they don't use it to actually build further upon it. But it's tricky, Morgan. It does raise a lot of questions, and the industry is figuring that out now. How much do you license? Who do you license from? How much do you pay? That's all being negotiated in real time.
It does seem like every day is some eye-opening application that you can envision.
Well. Looks like some people's jobs are going to be replaced. And the thing is that with all these uses for AI, we're going to have to look at energy and water consumption. Okay, so let's look at this article here and see what we can figure out where we should be going in our investment strategies. Yale Environment 360. I never even heard that they had it. Environmental school here that publishes. Here, I'll put the link in the chat. As use of AI soars, so does energy and water it requires. Generative artificial intelligence uses massive amount of energy for consumption and data storage, and millions of gallons of water to cool the equipment at data centers. Now, legislators and regulators in the US and the EU are starting to demand accountability. So this was written in February 6, 2024. 2 months. Oh, let me zoom in. Take myself off. I'm going to take away the chat here. 2 months after its release in November 2022, OpenAI ChatGPT had 100 million active users, and suddenly tech corporations were racing to offer the public more generative AI. Pundits compared the new technology's impact to the internet, or electrification, or the industrial revolution, or the discovery of fire. Time will sort hype from reality, but one consequence of the explosion of artificial intelligence is clear. This technology's environmental footprint is large and growing. AI use is directly responsible for carbon emissions from non-renewable energy and for the consumption of millions of gallons of fresh water. And it indirectly boosts impacts from building and maintaining the power-hungry equipment on which AI runs. As tech companies seek to embed high-intensity AI into everything, from resume writing to kidney transplant medicine, and from choosing dog food to climate modeling, they cite many ways AI could help reduce humanity's environmental footprint. But legislators, regulators, activists, and international organizations now want to make sure the benefits aren't overweighed by AI's mounting hazards. All right, so right now, it's not possible to tell how your AI request for homework help will affect carbon emissions or freshwater stocks. Hmm. The development of the next generation of AI tools cannot come at the expense of the health of our planet, Massachusetts Senator Edward Markey said last week in Washington, after he and other senators and representatives introduced a bill that would require the federal government to assess AI's current environmental footprint and develop a standardized system for reporting future impacts. Similarly, the European Union's AI Act, approved by member states last week, will require high-risk AI systems, which include the powerful foundation models that power ChatGPT and similar AIs, to report their energy consumption, resource use, and other impacts throughout their system's lifecycle. The EU law takes effect next year. All right, so we got all this stuff. Let's see. Those will include standards for measuring energy efficiency, raw material use, transportation, and water consumption, as well as practices for reducing AI's impact throughout its life cycle. Blah, blah. You see this big data center here in a northern Virginia suburb, an Amazon data center, no less. Very close to DC and the Pentagon, right? Right now, it's not possible to tell how your AI request for homework help or a picture of an astronaut riding a horse will affect carbon emissions or freshwater stocks. This is why 2024's crop of sustainable AI proposals describe ways to get more information about AI impacts. Okay, let's see. Working from calculations of annual use of water for cooling systems by Microsoft, Wren estimates that a person who engages in a session of questions and answers with ChatGPT 3, roughly 10 to 50 responses, drives the consumption of a half liter of fresh water. It will vary by region, and with a bigger AI, it could be more. But a great deal remains unrevealed about the millions of gallons of water used to cool computers running AI. All right. Very interesting. Data centers' electricity consumption in 2026 is projected to reach 1,000 terawatts, roughly Japan's total consumption. AI can run on many devices. The simple AI that autocorrects text messages will run on a smartphone. But the kind of AI most people want to use is too big for personal devices. The models that are able to write a poem for you or draft an email, those are very large. All right, let's see here. I want to see. Okay, big AI need to run immense numbers of calculations very quickly, usually on the specialized graphical processing units, GPUs. So compared to other chips, GPUs are more energy efficient for AI, and they're most efficient when they're run in large cloud data centers, specialized buildings full of computers equipped with those chips. The larger the data center, the more energy efficient it can be. Improvements in AI energy efficiency in recent years are partly due to the construction of more hyperscale data centers, which contain many more computers and can quickly scale up. Where a typical cloud data center occupies about 100,000 square foot, a hyperscale center can be 1 or even 2 million square feet. Estimates of the number of cloud data centers worldwide range from 9,000 to nearly 11,000. More are under construction. And the International Energy Agency, EIEA, projects that data centers' electricity consumption in 2026 will be double that of 2022, 1,000 terawatts, roughly equivalent to Japan's current consumption. All right, so I think that's a good summary of what we have here. I'll read this little tidbit. Google's data centers used 20% more water in 2022 than in 2021, while Microsoft's water use rose by 34%. So when I talked about utilities, you think about energy, right? So we talked about a couple of those stocks yesterday. Tropes brought up one of them. And now I'll suggest that we look into water as well. I do have one favorite water stock. I'm not sure if it's tied to AI, though. That's the question I have. I might have to do more research on my own to figure out which ones are the ones we should be looking at, because there's so many water stocks and very few people research them. You think water is boring, right? It's like, come on, you get bottled water. You got a utility company that provides water for a municipality, but you saw those numbers. Water is going to be a huge deal too. So not just electricity, water. So definitely got to look into that. All right, let me pull up my chart here. So let's review yesterday's stock that Tropes recommended, or at least he was watching. So it's good that he brought it up, because yes, there are a lot of these utility companies that we should be looking at. All right, let me start to figure this out. Get the StreamYards working here. All right, VST. Okay, saw this nice one. Look at this bad boy. Very nice looking stock. Very nice. It's amazing looking chart here. So VST, Vistra Corporation, and this ties into the nuclear energy and all this other stuff. So a lot of these companies which provide components and help build out new infrastructure for utility companies, they also will benefit, like this one. And we have others like Power, PWR, very nice looking chart here. So that's Quanta Services. This is a very clean chart. So there's a monthly candles right here. You see all the way from 2020. It's just been riding all the way up. So from that COVID dip, $25, it's about $300 now. This one, I love this stock. But I'm glad Tropes brought up this one. You see this one, it was stuck in a range for so long. So since 2018, when it started trading about 2017, it's been in this range. And only recently in 2023, we've broken out. And it's been a rally ever since. So definitely, you should put this on your watch list. I have another one. This one's pretty ugly since it's followed the stock market essentially in 2022. So that's an interesting point to note. You see this? So PWR didn't really follow the stock market at all, the broad market. You look at VST, it was already going sideways, so it didn't really matter. It didn't really have much movement even during the stock market dip. So that's interesting. NE follows it more, right? So this is Next Era Energies. Now these two other ones, PCG and Hawaiian Electric. Yeah, I like trading Hawaiian Electric here. Both of these have problems because they had the wildfire issues. PG&E with the California wildfire. That's why you saw this. They had to pay their little reparations to the people that got their houses burnt. Hawaiian Electric is in a similar situation with the Maui fire. But both of these utility companies, I think, yeah, PG&E is already out of the woods. You see, this is the big drops from all the bankruptcy court dealings. It's already recovered right back into range. So PCG is mostly Northern California electric utility, so it's quite important for the future. So a lot of the Silicon Valley work in California, they'll need it, so they can price gouge like crazy. Right now, my electricity bills in Northern California is quite high. So, Yeah, they can price gouge forever. I don't care. Like, let them price gouge. I just buy their stock, and I expect it to recover most of that from $20 all the way up to at least 50. Maybe it'll go up to 80 or more after that. We'll see. Hawaiian Electric, that's the only utility company in Hawaii. I don't think Hawaii has much choice. I doubt they'll let it go bankrupt, so just buy it. Hawaii has tons of water around it. They can desalinate, use that water. Who knows? People might actually build data centers out there too. They're hungry for any kind of business. So these are things to think about. Definitely things to think about. I think maybe I'll bring this one up. DOR, Digital Reality Trust. This one's interesting. This is a REIT. A REIT is a real estate investment trust. Okay, you buy the stock and they just own real estate. So it's like, just say John Galt comes out with a stock and monetizes his properties on the in the stock market. You can do it this way. And what these people do is that they monetize data center real estate. So this specifically is not like commercial buildings, residential, industrial. They actually have data centers, and they put it all on the stock market for you to invest in. So you buy a share and you co-own one of those little data centers, right? You own a little piece of it. And this is why later on I'm thinking, like, we should get a crypto John Galt coin, and we try to monetize John's properties in the crypto world. So I've been looking into that. I'm trying to figure it out. I think I need some help because I don't really understand the technology that well. I'm not really a coder, but that's something we can think about doing, right? Real estate can be monetized on the free world market, and everybody can get a piece of it. And that'll help fund John's operations. Any money you put in, he can improve. So he's looking into like fixing his stuff, improving his buildings. That will be monetized by you, the people. That's what the free market's all about. Yeah, what's up, Woody? What's up, Snake? Anyway, let's see. What's the next stuff I want to talk about? I'm going to talk about cycles next. I think it's very important because China has done their stimulus. All this AI requires a lot of infrastructure. So that means commodities is the next thing that will move up. We saw bonds move up for the last year and a half. Then stocks followed it for the last year, right? Now we got this AI stuff. Now we got China stimulating. Then we got Jerome Powell now ready to lower the interest rates more and more every time they meet. All this will stimulate growth in the global world. And what that means is people will start buying more and more commodities. They need copper for the copper wires. They'll need nickel and zinc, all part of your car, your batteries, everything, electronics. Tin. What else? What other metals we got here? Yeah, there's plenty of them. I can't remember. But we have to look into it. And one penny stock you can look at is TMC. TMC, okay? TMC, the metals company. This one I've been watching for a while. It had a little bump during the initial stages of the Russia invasion of Ukraine. And because people at that point were worried about, like, where am I going to get my nickel? Ukraine, Russia, they have a lot of land where they mine stuff. So anything that affects them will affect everyone. And what I would say is that this is an interesting company because they mine undersea. So they go in the oceans to mine. I think this is a very good speculative play. Very good. The only problem is, environmentalists get involved into this stuff. But hey, I definitely think it's something to consider in your 401k just in case it pops. Because if it pops, $1 to $5, $10 is no problem for a little penny stock like this. So when you get something near the beginnings of their business, you know, you got to take some risk. So that's just how it is. And I would say I would definitely be looking at this as one of those potential stocks in a commodity boom. So let's get to the cycles, because I think you need to understand business cycles and how they work. So let me play this video.
Welcome to the Market Roundup with Martin Pring. This is an annual tradition that was started many years ago by Martin and the Technical Securities Analysts Association of San Francisco, and has since grown into an international event. This program now reaches many thousands of technicians in all corners of the globe, thanks to the International Federation of Technical Analysts, which is an affiliation of technical analysis societies across the world. And thank you to them for co-sponsoring this event. And a very special thank you to Stock Charts TV and stockcharts.com for their production assistance and generous support in making this event possible. Martin Pring, as we all know, is an icon of technical analysis. He has written many books on the subject, including the seminal work, Technical Analysis Explained, which is a true classic. He publishes the all-important monthly Intermarket Review. Many of the studies that are going to be seen here today are published in the IMR through the course of the year. Last fall, he received the Lifetime Achievement Award from the International Federation of Technical Analysts, and he is the father of Techonomic technical analysis, and he is here with us today to present.
All right, so that gives you some introduction. Martin Pring is a big deal in technical analysis. So he's one of those really the grandfathers of doing this type of work. So I'm going to skip ahead now. Okay, I'm going to skip ahead to the section I need you guys to pay attention to.
In the previous chart. And in this chart here, you can see that the secular trend, the secular bear market is a trading range. And this secular bear market up here was a trading range. But we really need to go back and adjust this stuff for inflation. And that's what we do in the next chart. So there is the secular bull market from 1949 to 66. And then the other secular bull markets come in with these other red and green arrows. But you can see here that all the burglars occurred during secular bull markets, and all the bank robbers developed during the secular bear markets. So burglars markets, bank robbers for bear market.
So commonly the bank robbers are associated with periods of higher inflation?
Or excessive deflation as well.
Mm.
You remember 2009 here, 2007 to 2009, that was the latter part of that was associated with a huge collapse in commodity prices. So it's excessive inflation or excessive deflation that feeds these secular bear markets. So if we now look at these, uncover the lower panel, you can see here is our oscillator again. And this time it's a PPO with the same parameters of 60 and 360, except that the.
So I'll go over this again in my own charts, okay, to explain this further. But right now, all you need to understand, like, listen to what he said. Bear markets happen when in over excessive inflation or overly excessive deflation. So, right, everything has to be just right. It's a Goldilocks thing. You want inflation to hit your target. You don't want things to be deflating in a recession. That means, so you don't want to see commodity prices suddenly crashing because there's no demand. but you also don't want commodity prices just rising like crazy because there's too little supply. All right. An economy will only grow well when you have the right level of inflation.
PPO is calculated from exponential moving averages, and we were looking at simple moving averages before. Exponential, of course, turn much quicker than simple moving averages. And so we're actually got a marginal sell signal at the end of December. I wouldn't go a whole bunch on that because it's more sensitive. Sometimes it can give us false signals, and I want to see a more decisive signal. But it does give us the impression that the secular bear market could well be underway. It's just a warning. You notice also that the 2022 decline is in gray rather than blue or in pink, because we don't know whether that was a recession at this point or whether it was a slowdown. It was either a very mild recession concentrated in things like manufacturing and housing, or it was a growth slowdown. We just don't know at this point. So that's why I've got it in gray. But the amount of decline is more consistent with a bank robber than it is with a burglar. And as I mentioned before, the bank robber, as you can see from this chart, the bank robbers tend to occur during the secular bear markets. So now I'd like to zero in a little bit more on the business cycle itself, because the business cycle is nothing more or less a set chronological sequence of events. We've all heard of the leading indicators, the lagging indicators, and the coincident indicators. And they're called that for a reason, because some of the indicators like housing lead, and other indicators like capital spending lag the cycle. And the turning points of these various indicators is important. But for investors, the really useful part is that the turning points of stocks, bonds, and commodities are also part of this business cycle sequence and can be very helpful in determining what kind of environment we're investing in currently. So the cycle starts off with the bonds bottoming out, and they bottom out because the demand for credit, because we're in a contractory phase, starts to decline. And because we're in a contractory phase, the Federal Reserve starts injecting liquidity and that pushes supply up. So when supply comes higher than demand, the price, which is interest rates, fall. When interest rates fall, bonds bottom. Well, the economy continues to contract, but at some point, the players in the stock market start to anticipate that these falling rates are going to stimulate the economy, and so stocks bottom out just about the point where the news is at its blackest. But commodities continue to decline because demand is not picked up. But at some point, the recovery gets underway, and the demand and supply for commodities comes more into balance on the demand side, so the commodity market bottoms out. That's a great period when everything is actually going up. But of course, as with all great periods, all great parties, they must come to an end.
All right, so that's important, right? You see the three things: bonds, stocks, then commodities.
And as the Fed becomes less accommodative and commodity prices begin their upward or extend their upward path, bond prices tend to peak out. But that's still okay for stocks because the economy is still strong and the economy is not being hurt by inflation. But at some point, players in the stock market begin to anticipate the next recession or slowdown, just as they anticipated the recovery earlier. And then finally, commodity prices peak out. Now, what we got is three markets. Each one has a peak, each one has a trough. And that gives us 6 turning points in the business cycle, which is what we have in this slide here. And each of these periods is good for certain assets. So bonds are bullish in stages 1 to 3, and then stocks are bullish in stages 2 to 4, and commodities are bullish in stages 3 to 5. So at some point, everything's going up, and that's in stage 3, where you can invest in anything and it's a positive environment. And sometimes your investment are limited to bonds in stage 1 or bond kind of type of stocks, interest-sensitive stocks. And in another part of the cycle, only commodities and commodity-driven stocks tend to do well. So the question is, And we have at Pring Turner, we have models that help determine this bonds for bonds, stocks, and commodities. So right now we're in stage 2 because the stock barometer is bullish and bonds are also bullish, but commodities are bearish. So here's our stock barometer as an example of one of these models. It consists of 6 different indicators. And when you get a reading of 50%, where half the indicators are bullish, that gives us a bullish reading for the barometer. But these green highlights go a little deeper. They show in the barometers at 75% or higher. You can see that you get some really nice moves when it's at 75%. Right now it's at 83, so it's obviously meets that requirement. So we get this green highlight in the chart. So that's one of the indicators that's very positive. That doesn't tell us that we're going to have a good stock market for the next year or two, because it's only as good as the latest data and the latest trend. But right now it's 83% and looking positive.
And Martin, let me just say that in addition to pringturner.com, where you are managing portfolios using this research and among all the other research you do, but also the Intermarket Review publishes this information and the sector analysis and the business cycle work on a monthly basis. And so people can go to the Intermarket Review to be able to follow this research.
All right, so that's a good plug for Pring. So yeah, he lives in the Bay Area, so you can go find him, Pring Turner. You can look it up, his company there, and if you want to pay for his services, you can free feel to do so. I don't get a commission for recommending you that, but a lot of people might find it interesting. But what I'll share to you is the first thing he was talking about right here. And he was talking about the PPO. So that was the signal he used to figure out if there was a downturn in the stock market. You see? So this PPO I set. Now, I don't want to explain what a PPO is right now. Maybe later down the line, I'll talk about it. I don't know when. But you remember I was talking about moving averages, right? We were talking about the MA, simple moving average, SMA, basically. And then we were talking about the EMA. And I briefly mentioned that the EMA is very important for certain indicators. And one of the indicators I talked about at that time, I think it was two streams ago, I was saying that the Golden Cross and Silver Cross indicators that was created by, I forget his name already, but it's Decision Point. I think his company is called Decision Point. Him and his daughter, they made those 2 indicators, and you can go to stockcharts.com and look it up yourself, and you can find them. But PPO is similar to that in a way, but I don't want to get into the details. I don't want to get into the mathematics. All you got to know is that I set the parameters to how he set them, and you see this curve going up and down. Like you see 2 of these curves. Just ignore that they're 2 curves. Just look at the trend. It moves up, it comes down. It moves up, it comes down. And you see, I highlighted it for you, this red area, when it's below 0, and when it's above 0, it's green. So I think the biggest corrections we had were in these red zones here. But the major point that he was making was that when you saw a turn, when it hit this orange line I drew here around 65, roughly. So if it got above and started climbing back down from it, you would probably think, hey, stock market is probably going to turn. So this is the way you can time it through a secondary indicator like this. So you can see right here, before it got to the big trouble, we started crashing here in the 70s. All right, so that's pretty good. Now we hit the bottom. So when do I buy? Well, once it starts turning, it's probably safe to buy here. And also it's confirmed because the way the chart is moving, the moving averages start turning, right? So even if I miss the absolute bottom, I'll just be like, whatever. I want to be conservative. I'll just start buying here because it started to turn. It started to turn. And when it gets above 0, then you know, like, okay, it's time to be more aggressive. Now you see this part here, this 87 crash. This was a huge crash actually at that time. So if you're old like me, probably a lot of boomers remember this time. And that's why you see a lot of these boomers, they're always talking about the crashes because they never remember the good times. They always remember that time when shit went crazy and they started panicking. So the 87 crash was actually caused by a computer error or something. So you have to remember, at that time, computers started getting introduced into trading. And not only that, options. So you see Denison, right? And a lot of people in Robinhood and whatever, they're trading options like crazy, like gamblers. Options wasn't a big thing until at that point too. So you had options trading being introduced, and you had computers being introduced so yeah, that crash was caused because there was some problem somewhere. Somebody made a oopsie and it started a panic. But what you have to remember too is that even when you had this panic, it just pulls back and it still respects the moving average. So, and let's say you could try to anticipate this crash. I would say that if you looked carefully at these bars here during the 85 to 86 time frame, you kind of see that it's moving very far away from the moving average. So you can see that people were being greedy. So not only you had some computer issues or options trading issues, you had people extremely getting way too. So whenever you see this, when it's starting to move way too far from moving average, or you get to like modern times, like in the 90s, right? The late 90s, you see this? This is like way overstretched now, because once you started seeing this move far, and then the next leg goes even worse, and you start seeing these type of volatilities. Like, look at this one. This was 1 month's worth of losses at 14%, and still people kept buying. So when you see high volatility on that time scale, so this is month. Each candle is 1 month. You got to say to yourself, hey, something's wrong. Something is systematically wrong. And this was the .com bust because everything was overvalued. You had pets.com, you had everything.com. Anything with a .com was like going gangbusters. Everybody could buy everything that was .com. It didn't matter what it was. They just assumed that if it was anything related to the internet, it was good. So it's kind of like the meme stock era of that time. You had a lot of people doing it. Now, if we look further here, so look at the way it's moving in those 90s. You see the curve. It starts breaking away from the orange one. So the orange one is sort of a subdued curve because it's just a moving average of another moving average. But once you see this blue line just racing out, you know it's overextended. And not only that, it went above the 65. So once it starts topping, you see this topping area, and it starts moving back down, you have to wonder, because it's falling from a high level here. No. The next few candles, you go down 7%. No way. And then the next several candles later, you go another 7%. So if anybody was thinking of selling, you should have been selling at least at this point, right? Because you're about to hit here. And if any dummy just kept holding on to all their stocks all the way down here, you're dumb. You're really dumb. So that's why you look at these secondary indicators. You can see when these bubble areas start happening. Now, we almost hit it right here. Look at that. Again, just before 2020, just before COVID. So if you looked at this indicator, you could have probably just sold anyway, even well before you knew where COVID came from, because like COVID was already being talked about in China around December. All right. But nobody in America gave a shit in December. January, you might have heard something more. And definitely February, it got really heated. But you could see like something was up. Something was up. We were starting to get overstretched. So do you think COVID was being used to purposefully pop the bubble so that we could regain the momentum for the next leg up? Because I feel like we are now in the same situation as 95, this era here. So we kind of popped that bubble and we're ready to go for the next ride up. That's what I feel like. Now, this indicator is not perfect because you see here, it didn't catch the 2007 crash. You could probably use other indicators to give you. I gave you those indicators the other time. I gave you the discretionary XLY to XLP substaples ratio. That one would have caught it. But in any case, during this time period, the stock market wasn't doing very well anyway. And if you see here, what I'm showing you is the inflation adjusted. Well, let me do this again. I think I should merge this with the other axis. Blah blah blah. Pin to scale. Oh man, I gotta redo this one, I think. Inputs, visibility, I want everything to be on the same scale. Merge scale, percent. Yeah, I want this all in percent. Let me do this again. Same percent scale. Okay, here. Let's do it and change the color. I like that maroon color. I like that one. Okay. So the candle bar I showed you is inflation adjusted. Now, if you don't adjust for inflation, you know, everything here looks pretty good for you. Because let's say I bought at the bottom of the 2009 low. So if I didn't take into account inflation, you would think like, well, I gained 500 to 40% on the SPX, so the S&P 500, if I was just being lazy and just followed the index. If I adjusted it for inflation, and this inflation, I use the PPI numbers, so that's the producer price index, that's only 300%. So actually, I didn't gain as much because of inflation. So if I go all the way back to the 70s, here, you can see how different my actual returns are. So in nominal terms, my S&P 500 results are nearly 5,000%. But in reality, because of inflation, it's only about 677%. All right. So that's something to consider because, you know, you kind of look at these distorted graphs. It kind of makes it look better than it is, because if you see during the George Bush era, from the dot-com after Bill Clinton left, dot-com crash, to when the end of his second term, just before Obama came back, you see we hit the same top. So we hit the same top, but in inflation adjusted in terms, we actually made a lower top here before we crashed. So commodity prices was actually going up at that time. So let's go back to commodities now, right? Go back to the commodities. That's why you have to look at what the commodities are saying. And I think during that period, gold was one of the things that was going up. I'm not sure if oil was. Yeah, I'm not sure if oil was. But if you just look at the producer price, you see that? Look at that spike during the George Bush era. Man, that's a lot of increases in the price of commodities. So energy, metals, anything. And we're at this stage again, like here during COVID. So that was a supply shock that was causing the COVID one. We pulled back. We pulled back some from that you're not seeing that in the supermarkets or anything. Definitely not. So even though the input prices to the producers are going down, they're keeping the prices elevated. So when you see this price shock here, yeah, the only way you're going to see that in your daily lives is when we're entering a recession. So I doubt that's going to happen at this point, unless Jerome Powell does something stupid or something crazy happens that I'm not seeing. But for now, I think we'll be fine. Unless, yeah, just pray. All right, just pray. I don't want any more global geopolitical tensions or anything like that. We just don't have the patience for it, and we just don't have the margin for error for it, because we are at a point where China now is boosting their consumption. So this is what you got to watch out for. All right, Woody. Yeah, I did get your emails that you sent to everyone. Yeah, I'm not in charge of that. You're gonna have to deal with Portia and HB or whoever. I don't know if John is even knowing what's going on there. You got to deal with that. Let's see. Yeah. Well, what is the right level of inflation? That is set by the Fed, and most global bankers probably would say 2% inflation is their target. That's their mantra, 2%, 2%. I don't know why they picked 2%. And you said worse is that you can never time it. Well, I showed you can time things if you know what you're looking for. And that's why if you have many different secondary indicators, you can probably catch all the bad times and all the good times. And this is why I keep introducing you to more and more people, because the more you know, the more you can distill information correctly. And the only problem I would have is that I don't want you to get too crazy about over analyzing things, because you could end up to the point where you're just having analysis paralysis. And that's a common problem with people. You just overanalyze things, and you have so much data and so many little indicators that now you just get confused, because there's so many of them that give you different signals, right? So you're going to have to put them in an order. You're going to have to figure out which one has a dominant effect or whatever. And you're going to have to figure out why this one is disagreeing with another. So you're going to have to use your brain and start understanding why things are from an economic point of view. And that's the whole point. Data is always going to be conflicting. And this is what I brought up yesterday, right? Because we have two jobs data, and the stock market only cares about one of them. So let me repeat it from yesterday's stream. The diverging jobs numbers. Which one is correct? So there are two surveys for jobs. In the United States, two primary surveys provide insights into the labor market. The Payroll Establishment Survey, so this is the Current Employment Statistics, CES, and the Household Survey, Current Population Survey, CPS, conducted by the Bureau of Labor Statistics. These monthly surveys differ significantly in their methodology, coverage, and the type of data they collect, yet both are essential for providing a comprehensive view of employment. So I won't go over it again, but you can see two of them show a different story now. They usually follow each other, but since November 2023, they started diverging. So what does that mean? Now, some people on the internet and pundits and economists you can hear on CNBC, Bloomberg, whatever, they'll take this and say, aha, the government's lying. The blue one is what Biden wants to show you, and the purple one is the truth. That's one way you could spin it. You could say that. You could definitely say that. You could just say, like, economy just sucks right now, but we're just pretending it's not. But there was another reason why these could be different, and I gave it to you at the end of this article. And here's the thing. The main reason why the household survey might be off is due to the surge in migration that the U.S. experienced in 2023. In a press conference earlier this year, Fed Chair Jerome Powell acknowledged that the U.S. labor market and economy were booming, thanks to an increase in labor supply driven by immigrants. There is a precedent for the household survey to underestimate job growth. In the late 1990s, illegal immigration into the U.S. surged. Okay, this is why I want to talk about cycles. I tell you guys, everything repeats and repeats. Human nature repeats, politics repeats, empires repeat. If you can understand cycles, you can time things. So this is not new. We are at the same point we were probably in 1994, 95. I remember those times. That was when California allowed the illegal Mexicans in California to stay. All this stuff happened then. This ain't new. I'm old. I'm ancient. I remember this stuff. Now, illegal immigration into the U.S. surged during a time when the economy was doing great and the labor market was booming, not unlike today. Back then, a big gap emerged between the payroll survey and household survey estimates for job growth. After the 2000 census captured the immigration increase, the BLS concluded that the employment based on the household survey was understated by about 1.6 million people. If that sounds familiar, it's because we are facing a similar situation right now. The census data shows a 0.5% increase in the U.S. population for 2023, while CBO, the Congressional Budget Office, economists have estimated that the true number might be closer to 1%. They believe that the U.S. received about 3.3 million migrants on a net basis last year. Undocumented migrants are less likely to participate in the household surveys due to fear of exposure or deportation. This will lead to underreporting in the household survey. Employers, on the other hand, may still report these jobs in the payroll survey. There you go. Now, this is a big inflection, man. Big inflection. Because if we are, in fact, in the same situation as 1994 to 95, then get ready, guys. The stock market is just going to be pumping like crazy. And this time, we got a new .com effect, AI. And AI is way more bullish than the .com days. Back then, the internet was primitive. So this bubble still has legs. If you want to make big money, you better make it now, because I think the next 2, maybe 3, hell, if the bubble can last even 4 years, you can make a ton of money, a shit ton of money. AI is overhyped. It doesn't matter if it's overhyped. Hype makes money. Hype makes money. That's where I make the most money. It's when people hype shit up. You want to dismiss hype? The power of greed is great. This is where real wealth is made. Every time you miss it, you miss your chance to get out of the doldrums of being a slave. This is what I keep telling you guys, man. You guys really got to understand. If you really want to make it, you need the rocket ship to get you off Earth, because there is an escape velocity for poverty, and you better catch it while you can. It doesn't matter what I believe. It doesn't matter what you believe. All it matters is that people want to buy stocks. It just goes up because people are irrational. A mass of pigs running around is irrational. I don't care if the pig is dirty. I just want my bread, bitch. So let's go back to this chart. You saw the two things. You saw commodities. You saw stocks. So I'm going to take those off. Now let's look. This is when I bought Apple. So I told my parents to buy Apple around the 2000s. So see, now I didn't make 3,000%. Okay, guys. This I probably, let me see, 90s. What was it? 9,000%. Maybe I bought it. It's hard to time it around here. Okay, maybe. Okay, I didn't make 32,000. All right, I didn't tell them to hold Apple that long. I mean, they probably sold around here, like maybe 5 to 8,000%. All right, So that's good. That's good. Not uber rich, but wealthy enough. Now, when I was in school, I bought, let's see, AMD, Tesla. All right, so these weren't bad. So if I was in school, in grad school, and undergrad, so maybe around here, right? Not bad. 2,000%, 3,000% at most. I mean, I didn't hold it all the way through here. I mean, I pretty much like probably got out just into COVID or something like that. I just got the F out. But I bought at different times, so I'm it's not precise, but you could see like, yeah, when you get a good stock, that's really nice. But when you get something like this, look at Nvidia. I wasn't in Nvidia that much, but look at this. This is insanity, right? Nvidia just really outstrips everyone in terms of, so let's say you bought right at the beginning of the NASDAQ rise in 2013. That was see, you got most of that move to 32,000%. So if you held it, like, shoot, man, like let's just say you came in late. Let's just say you came in during COVID. You still made about 600%, but let's say you just bought right at the beginning. Fuck, that is 32,000%. Man, it's almost 32,000 if you bought right at the bottoms. So that's how big this bubble is for Nvidia. And if I put Apple back up, it doesn't compare. Look at Apple. If I bought Apple like right here, like 2013, like come on, compare to Nvidia? Nope. How about AMD? Nope, that's only 5,000. That's lame. Tesla, 8,000. Lame. Now, here's an interesting one. I like this stock. I bought it because it's an energy drink stock. Look at this. Oh, I got a stock that kicked at Nvidia's ass. It was like some stupid ass energy drink company. You see this? You see this shit? 90,000%. Now, like everybody talks about crypto. Well, how does Bitcoin compare? Oh, not bad. Look at Bitcoin. If you got Bitcoin right at the beginning, it's 250%. You okay, you whooped me on that soda energy drink bullshit stock. But like depending on when you bought Bitcoin, like dude, you just matched that energy drink stock. Or maybe you even might lost it if you bought at the wrong time. So yeah, all this stuff, you gotta be careful. It's just like everything has such an interesting flavor to it. You buy different stocks at different times. It might change completely how much you gain. And everything is based on the cycles, right? On cycles and also the hype. It's just amazing, truly amazing human psychology. In any case. Well, yeah, okay. You can keep saying that. Nobody cares though. Do scientists have money to buy stocks? Or do idiots on Main Street that follow people on CNBC buy stocks because they got 401ks and shit? Tell me that. It doesn't matter what reality is. Stock market is not run on reality, all right? Was that Celsius? Yes, that was Celsius. that was one of my big winners, man. Because sorry, it's crashing right now though, so I'm waiting to get back into it. But you know what? It's probably over for that stock. It's probably better to jump in and try to find a new one. That's why I'm telling you guys, try to find the next big thing, guys. You had AMD, you got Nvidia, you got Tesla, Apple. Come on, find something new. Find that next 30,000% stock. I don't know what that is, you know. So, and that's why I'm trying to help you guys, because if you know, a lot of my stuff has been lucky, but from what I've learned so much over the years, it's like it didn't need to have to be luck. Had I had the knowledge to analyze stocks through technical analysis the correct way and with charts, I could filter out all the noise, pick out all the winners. Didn't waste my time putting money into blah blah blah, right? Just spray and pray. You only have a limited amount of capital as a small investor. You don't have big money like the big guys to randomly bet on everything just to get that winner. You got to be very conscious about how you allocate capital and try to maximize it through picking wisely, right? And one way to filter out the noise is through, of course, hype crashes. I'm trying to teach you how to get the hype and avoid the crash. Oh, man. Why do you think I'm doing this? Oh, why do you think I'm doing this? Otherwise, I wouldn't even bother telling you how to do things. Okay, anyway. Yeah, just give up. Just roll over. You know, just avoid doing anything. Because that's all. If that's what you want to do that. Because otherwise you cannot get that generational wealth like I did. There's no way. If you just want to give up, just give up, man. You're just gonna miss the train. And then you get mad and you buy at the top and then sell at the bottom and do all this shit. Yeah. That's just how it is. Every time I see that, people just miss the train and they go like, oh man, that stock keeps going up. How did you figure it out? And then you buy at the high and then you panic when it starts crashing. And I already sold already. And it's like, you missed the train. That's you, right? Is that you, the loser? Or you want to be the winner? Stay tuned. That's why I got to do all these streams right away before the end of October, because we are potentially entering in the next hype phase. And that next hype phase is going to be crazy. Okay, if that's what you want to do, hold the bag. I don't care. If that's what you want to believe too, it doesn't matter to me. I would do the same thing anyway, with or without this. Did I need a bunch of streams? I never streamed before in my life, man. I could just shut up right now and be like, okay. I just continue doing what I'm doing privately without telling anybody. And it still wouldn't matter, because then people would just be bitching at me. It's like, why didn't you tell me, man? Why didn't you tell me, man? And then when I tell you, it's too late, and then you buy at the top and get mad at me. That's just how it goes, because it's human psychology. Human psychology defeats you before you even do anything. That's it. That's exactly what it is. So let's go. Let's learn some cycles today. Let's learn some cycles. So this stuff might be too complicated for you guys, but I'm willing to take a risk to present it to you. Let me see.
Williams, who had been out there for a number of years before me, when I was exposed to Larry's work, which is based on patterns and cycles and seasonals, it changed my life. So I owe it all to you, Larry. I hope you have a great presentation. I know it's going to be fantastic. And I'm humbled by the amount of effort that you put into this work and all the great things that I've learned from you, Larry. So I'm going to give it back to you, Ron, or back to you, Larry, whichever you prefer.
Back to Larry. Over to you.
Okay, well, let's do it. Jake, thank you very much. It's a real honor to be here, and especially to get those comments from Jake. Jake and I have been friends for, well, more years than we can remember at our age, I think. So it's always flattering to think that somebody would even invite me to come talk about this stuff. So I appreciate it. I hope I can teach you a few things today about the markets and about how I see the markets. So let's begin with that. We'll start with my PowerPoint, which is, I think, a huge important question. Can cycles help us see the future? I mean, we really have to get that answered. There's so much stuff about cycles out there that doesn't work, hasn't worked, and we need to get some factual analysis about what does work with cycles. Everything has limits in life, and I think some people take the potential for cycles way beyond the reality of cycles. So I'm going to try to document some of this. Are we just kidding ourselves? We need proof. So I'm going to give you some proof, and then I'm going to show you how you can do this as well. This is a forecast we made in 2023, my natural cycle forecast, private formula, doesn't matter what it is. But you can see what the forecast was for all of 2023, a bull market, and a lot of strength at the end of the year. That was the forecast actually made in 2022, and this is how that came out. So there is evidence that we can get a view of the future. Is it a precise view of the future? No, not really. Can we call a market to the day? I don't think so. A lot of people claim that you can, but I don't think that's important. If I know, generally speaking, I want to look to be a buyer in this area or a seller in this area, I'm way ahead of the game. It's
Hey, Larry,
kind of like,
this is Richard,
yeah.
and we need you to share your screen.
Share screen. Oh yeah, let's do that. Is that better?
It's coming beautiful. Thank you.
Okay, we see it now. Okay, so we'll go back. That was the cycle forecast. And then this is what actually happened in the market itself. So to me, cycles are largely two things: a setup tool that says I want to be looking for sells at this time of the year, taking profits. I want to look for buyers over here, an entry in the market. If I like the stock, I'll talk more about that. So it's a long-term version. One of my real thoughts in 2023 is to be successful, you need to have perspective and patience. So how do you get perspective? Well, you read somebody who's very bullish or bearish, and maybe it gives you perspective, but if they're wrong, you're really lost. I think cycles give you perspective of the overall trend of the market and when the best points to be a buyer or a seller are. Then that allows patience. That allows patience so you can persevere. You have perspective, and the markets are tough, but how do you persevere? Well, here's a good case. I started buying the S&P in here heavily, and I got losses here. I got losses over here, but I had perspective so I could persevere through this and had a huge, huge run. You can only imagine, because I really loaded up the market in here of what's happened in this rally. So cycles give us perspective that allows us to persevere. It gives us some patience in the market, like when to wait for this time. So I think that's how I use cycles in terms of using them as a trader or looking into the markets. Here's a little more proof of the markets. This is the forecast we did for 2023 for Nvidia, one of course the big all-time stocks. And you can see this is the path. We thought from July into the end of the year be a 90% probability of a rally in the market. And these are when the significant lows and highs should come. Those are the buying opportunities in the market. That was made a year in advance, okay? How did it come out? Well, there's the lows. You can see what happened in the market. There's that rally that we saw that we would see from over here. So it is possible to generally predict what's going on. But am I going to predict the absolute hour? I think there's too much erratic activity in the market, too much irrational stuff, news, whatever happening, that I think I'm going to absolutely call the absolute high of the day of the low of the market. I'm more concerned about, oh, that's the path. I want to look for be a buyer in these areas. That's how I use this stuff. Here's a forecast for you for 2024. This is an actual forecast we're making for Rockwell. So about January 8th, I would expect this market to come down until about the middle of May, rally up to around the first part of August, pull back into the 10th of October, and start to rally again. However, there's something called inversion in cycles. My good friend and Jake's good friend, Wells Wilder. Jake traveled all over the world with Wells, and I've met Wells and helped Wells get going in the business. Wells said cycles can invert. And I said, oh, that just means that the cycle was wrong. He said, no, he called it an inversion. If a top became a bottom, I said, you're dead wrong. He said, no, it's an inversion. And I've come to believe that Wells was really on to something. So it could be, let's say that Rockwell rallies all year long. Then if it rallies up in here, that May 13th time period would be a peak in the market. So these dates are equally important, and there should be a cycle reversal. And this is the important thing about cycles here. This is when the cycle should reverse. Maybe the cycle is going down. It doesn't matter if the cycle is going down or up. There's a reversal at these time periods. That's my expectation. Also, huge important thing. People think that cycles predict the magnitude of a price move. It looks like a big price rally, a big price drop. No. Why? Cycles measure time. They don't measure magnitude. Cycles are how many days, how many years, how many months. They're measuring time, and they might get the length of the time move from here to here, but the magnitude, the price scale, which is where we get paid over here, is not a part of cycles. That's something else that we really haven't quite captured, in, at least I haven't, in my meager cycle studies. So I know since we've been rallying, this should be a peak in the market. That should be a low in the market. But as we get into May, we'll look.
This question here. So why even bother with the individual stock trading if we're due for another boom? Just throw in another index fund. Well, that's up to you. Everyone has a different situation in life. If you are old, yes, you should just do an index fund. If you are young, you should be trading in individual stocks that you know will outperform that index fund. And what did I show you earlier? I showed you a commodities boom potentially, and I showed you utility stocks. So whether or not you believe in AI or not, electricity and water is being used. Think about it. Think about it. Utility stocks are generally very undervalued in general. And now we have interest rates being lowered. Utility stocks give interest. If bonds cannot compete with utility stocks, people would rather buy utility stocks because at least they have price appreciation that they might not get with bonds. So you got to think second level, tertiary level, all these other levels of how to look at the money, because money flows and money is greedy. They will search out things that will outpace the normal index. That's the whole point. You are there to beat the game. If you're not there to beat the game, then forget it. Just forget it. Because at that point, you have basically told me that you are retired. You're just trying to do safe investments. And if that's the case, then all you need to do is time the troughs and booms of the cycle on a larger scale. And that's it. That's all you got to do. But if you are aggressive or you are young, you should be trying to outperform the index because that's the way it is. Is the benefit outperform? That's what risk premia is. That's why you have to learn about risk premia. This is, John went over risk premia already. Like when he rents to people who's in the hood versus who's in like the quote unquote gentrified areas, he's doing analysis of risk cost benefits and what it is, right? You got the cost, you got the risk, you got the benefits, you gotta do it yourself. This is homework. This is something you have to do as a personal level and an individual level. And so that's why I'm not a financial advisor. A financial advisor would look at your situation specifically, how much capital you have to invest, how much free income flow you have, what are your risk tolerance, and what is your age. Where do you plan to retire? What age? Things like that. And that's what they would have to do. All I'm telling you here is I'm giving you concepts. There are many concepts of how to time the market. It's up to you to use it for your own benefit, for your own style of investing. You can use these concepts to day trade. You can use these concepts to swing trade. You can use these concepts just for investment over many quarters. Or you could just use it to essentially tell you, hey, this year will be better for stocks and worse for bonds. I'll reallocate my portfolio to have an index fund, right? I will just be like put more money into a stock index fund compared to a government bond fund, compared to a municipal government bond fund, compared to a emerging market bond fund. You know, there's so many different types of fixed income levels and stock market. Like you could break down stock market into tech, growth, value. But if you don't know cycles, you don't know how to allocate. So even if you're not day trading, swing trading, or whatever, you still need to know this stuff. Because tell me, where would you allocate? You can't, because you don't know where we are in the business cycle, right? I just told you the business cycle. And the business cycle has bonds, stocks, commodities. Three major things. And we can break it out down even further. We can go to stocks that are value stocks, blue chip stocks, riskier NASDAQ tech stocks, like bam, bam, bam. And so that cycle was so simplified. And we could break it down even further, so many different ways. But, it's up to you, because a lot of people won't have time to do all that analysis. They just won't. And that's what like the big boys in the big banks count on, because you don't have the time, you don't want to do the legwork. So they would just give you a product, charge you a percentage, and say like, okay, you have a target fund that goes to 2030. You're going to retire in 2030. Here's the fund we have. And, they're lazy too. They're not going to do any like extra boutique, like bespoke investments for you. They'll just be like doing the dumbest thing possible. They'll be like, oh, we're just going to do 80% bonds and 40 or like 20% stocks, blah, blah, blah. Like, dude, bruh, you can just do better than that. Just doing a little homework, you can do better than that. I swear to God, you can. So that's what I'm going to try to do. I'm going to try to get you to that level. Hopefully, we'll see. Because it'll be hard for me too, because I'm trying to give advice from a financial level, advisor level, which I can't do. I just do stuff for myself and my parents. I know their situation, I know my situation, but it's something where I can't give it to everyone. Everyone's gonna have a different like mental ability, because it's a psychological thing too. So not only a psychological thing, but it's your financial goals, it's your financial situation. It's so individualized, and that's why a lot of people, they don't want to get into that work. They rather just do stuff for themselves, or they just work for a hedge fund and they just try to make money however they can. Just trying to advise people how to do things is just painful, man. It's just so painful. And, my boomer parents, they were the same way. They were just like, oh man, stock market's always crash. Oh, I don't trust the stock market. Hell, if they were always like that, man, they wouldn't be where they are, because they didn't listen to me. And that's the thing. It's so psychological. So let me skip ahead here.
See, this idea of best fit may be the way to handle the decennial cycle. Going just a little bit further, the purple line now is all years ending in the 0. So this would be the decennial pattern itself. But if we took those from the best fit, we get a much better example of a forecast for them.
So what he's trying to do is, this is the dumbest way to do cycles, okay? Like, I'm not saying dumb like as an insult. I'm just saying this is the most simplified way to do it. You take all the stocks performance, like an index, from the index, like S&P 500, Dow Jones, whatever. You take it from every year ending in 0. Okay, so then you think that because everything repeats based on the ending digit of that year, so 0 years would work the same way every time, and the 4 every year ending in 4 will work at the same time, something like that. It's just like that's what the decennial pattern is. It's just like, okay, and for every 10 years there's a repetition. Okay, um you know, okay, that is something you might look at, but you're in the United States. The United States, has a 4-year election pattern. Okay, so you have to keep that in mind, and we'll get into that a little later if we have time. But for now, because I mentioned it before, I think in a couple streams ago, or maybe 3 streams ago. But I think I'm going to show a picture here before we continue in this video, just to clear your mind, because last stream we talked about it. So let's refresh your minds here. All right, I found it. Oh man, StreamYard is so annoying. Here, so this is what I presented in a video last time. So the Wyckoff guys, they talked about the 10-year cycle. So that's what Larry meant by decennial. Decennial means 10 years. Everything repeats on the last digit of that year. So let's go with this now. I personally think this is kind of simplistic, but the 5th year, so every year ending in 5 is a bullish year. Now, if you go back in history, that's not true. Okay. But let's say we believe this and we simplify our work here and say cycles work on this simplified pattern. Stock markets love years ending in 5. If that's the case, we are entering a 5th year. And then remember now, I told you guys that we have a lot of illegal immigration, just like in 1994 to 1995. And what happened in the 1994-1995 period? We had a big bubble, right? Starting at that point, going all the way to the dot-com bust. So now you got the AI, you got the immigrants boosting the labor market. These are catalysts to pump the stock market for the next several years, at least. So get ready. If there's a hype train, I'm going to get on that train and ride the bull until I cannot stand it and get the fuck off. I'm old now. I probably won't ride that bull too long. But you guys that are young, hey, you can take a bigger risk. You could buy more of those riskier stocks and ride that bull longer than I can until you can't handle it no more. So that's all I'm saying. All I'm saying. You haven't seen anything yet. When I remember those dot-com days, it was crazy. Everybody was buying everything. And that bubble looked like it could never end for so long, right? Because there was that crash in the middle in 1998, 14% in 1 month. And that bubble still went up. That's how greedy people were at that time. So get ready. You never know. When there's a mass hysteria, that's the best time to make money. All right, we got this question here. Any way to rank your performance? The metric I would use is you have to beat the index. So the S&P 500. So that's why starting in the end of this month to November, I am going to have model portfolios. I'm going to have something where I have ETFs. I'll try to rebalance them, and I'll say, hey, can I beat the S&P 500 just by doing stupid stuff, simple stuff where I just rebalance my portfolio just using ETFs? If I can do that, if I could just beat it by even just 5%, just beating the S&P 500 year over year, or even month over month consistently by just a few percent, you are God, because that is such a hard thing to do. Most hedge funds probably can't beat more than 25% in a good year. All right. So just having a consistency of beating 5 something percent, yeah, you made it. You made it. So just doing simple things. I just want to prove that it can be done with the most simplest techniques, the most conservative techniques. And with that, you could say, like, if I want to be more aggressive, take on more risk, then, I have to fine tune things. And that's a personal matter. And that's why risk management, we'll have to discuss that probably tomorrow, where I'll say, like, okay, how would you plan when you should sell a stock? Looking at volatility and things like that. I think that's something we'll have to introduce over time. So we'll start one lesson tomorrow with that. I think that'll be good to start off with. I think people might have more advanced techniques. You might want to ask other people. I'll try to show what I've learned, and maybe what other people have tried. And it's similar to, like, where you try to do odds and gambling. I think there's similar ways. Those techniques would still work in the stock market. So you could try to use some techniques from gambling, where you try to enforce risk management based on odds. I think the real problem with stocks is that you can't get good sense of what the odds are. And that's why I feel like this is where we need to improve things. So if we look at charts, we have to have specific odds for certain bets. And I think that can be improved. Maybe we'll discuss that later on. But for now, it's just basic knowledge. And from knowledge to application. And then from application, we can do refinement later. That's what I want to do with this channel. It's just, I think a lot of you guys are way smarter. You're younger than me. You got ambition. I'm sure you could just start programming things, doing things in scripts. You're more technologically savvy. I think you could just get, like, a lot of people are just using AI now to do things. You could just make the AI do it too. If we can do that, man, that's really good. That's really good. You have a core team of people that are doing things. But right now, I just want to introduce you to concepts. So again, we got our election year. We're going to the 5th year. After the noise of election, I think we're going to have a boom time. And this is why you got to pay attention.
Is it highly accurate? No. Do I have better ways of forecasting the market? Yes. But generally speaking, most people want a quick and dirty way of forecasting the market. Most people are aware of the decennial pattern, and I think this is the way to do it, based on the assumption of cycles of repetitive action in the marketplace. Let's take a look at 2021 to forecast 2022. The red line is all years ending in 1, and this is the black line, of course, is 2021. And it wasn't a perfect match. It called a rally at the first of the year, a rally here, but the best fit, those are the years that best fit 2021. There were some years that ended in a 1 in that decennial pattern that were a best fit to 2021. So how did that carry forward into 2022? As follows: the blue years got the high, whereas the red years said the high of the year would come over here. Wrong. And they both were in pretty good sync rest of the time, but on balance, the blue line did better than the red line. In other words, those select years that were most like the last year predicted better than all years. Then we can see all years in 2 are blue line, and they did okay. But again, the prediction from the prior years did better. So where are we right here, right now, right? What's going to happen in 2024? That's why you're here today. That's why you're watching, right? This would be the projection. If we take all years in all 3 years in red, that projects out like this. If we took the ones that best fit 2023, that projects like this. Actually, quite a bit of a difference. We see the best buy point would be August, the middle of October, and a strong year-end rally. So for those of you who have followed the decennial pattern, I know the Foundation of Cycles have a lot of work on the decennial pattern. I think we have a new way of looking at it. If you pull out those years that best fit the current year, then take those next 12 months forward, you get a better projection of what should happen. Perfect projection? No. Are there better projections? Yeah, I think so. I do that in my cycle forecast I do every year. But it's a pretty doggone good way of getting a quick and dirty projection of what's going to happen. And that projection says a rally first of the year, come down, and we end up higher for the year. That will continue in a bull market. At the end of 2025, or 2024 rather, you see which markets best fit 2024, and then take those years to make a projection to 2025. I'd like to say it's just that simple. I hope that that's been simple enough for you to understand. So if we use 2024 using all years ending in 4, that's the light blue line. That would be the typical decennial pattern versus the one I just explained to you.
So you see all these different ones. So the blue one was just using the 2023 pattern and then projecting it out into 2024, all the composites. And then the red one was all the I think, oh yeah, all the 3 years. Was that the 4 years? No, the 4 years. So the 4 years with the light blue. Yeah, the 4 years with the light blue. I think that one was closely matched what we had so far. So we're in October right now. So I think the way 2024 worked out was halfway between that red one, which is all the 2023 years kind of, but it was too extreme because we actually rallied it starting in June. So this red balloon where it just started pumping into August was kind of too late. This one actually started in May. So yeah, you can see it's not perfect, right? None of this stuff is perfect. But for truth, it did drop in April. We did rise over the summer. So overall, roughly, if you just like didn't trust this in a precise sense, as he said, you can't use this as a precise timing tool, but you could say like, yeah, starting around April, you were going to see problems. March, April, you're going to see problems. And then during the summer, you would see a rise. We saw that. Then we see another drop in September. Yeah, I think we saw that, right? We did see that. So August to September was bad. And then we had another drop. We had 2 drops, one in August and then one in September. So we had noise there. So this is why this is so hard, because you have different like predictions based on all the things. This is why I don't like this personally. I don't like where like you simplify the thing where like I'm just going to look at the years ending in 4. I'm just going to look at the years ending in 3. And then I'm superimposing all this, as you say, Eric. That's right. He's just superimposing them. Now, this is how they did it in the old days, mostly. So this is why I'm going to show you how the modern way is done with Bitcoin. Okay, so we're gonna do something more advanced now. Let's see if we got time. We got time for this. Let's start it. This might get even more advanced, like way more advanced. Like so, I think it's the same video. Yeah, this is the same video. So it's the next presentation. So let me get this timestamp here. So this is the new modern day. This is the new modern day analysis. So that's the old school analysis. This is what the boomers did. Okay, you have to remember these guys didn't have advanced computers like we have now. So now we're going to the next generation.
Paying $1,000 and more for the first edition of this book. link in the chat if you want more information about how to donate to the foundation and also for this book.
So let me remind you. So I am a member of this society. This is the Foundation of the Study of Cycles. But they look at everything, not only in stocks. They'll look at weather patterns for crops, and things like history, where empires rise and fall. So they do everything.
This is to celebrate the historical republishing of Dewey's book by Harriman House. You can see the front page cover there, exclusive for everyone to see ahead of time. The world's most prestigious financial book publisher. So that's the transition infomercial in terms of who we are, benefits to becoming a member, but then also what to look out for in the year of 2024. And now our next speaker, FSC board member, Lars von Thienen, founder and CEO of a knowledge management company. Von Thienen develops algorithms and software for cycles recognition. He's published 2 books on cycles analysis and invented a standalone desktop search and knowledge management app. Watch Von Thienen, most importantly, on Market Cycles Report every Monday at noon ET. A star on that channel that you can watch on a regular basis, but also, as I learned some time ago, interact. You've got live questions you can actually ask in the session, which makes it even more impactful. And as I just mentioned, a board of directors and a good team colleague. Lars, good to have you back. And I saw
Hi, Ron. Nice to be here. Yeah, sure. I mean, a financial summit without a session on crypto is not a financial summit, isn't it?
Absolutely. And actually, as I was getting questions on the chat, just for our previous guest speaker, Larry Williams, crypto did feature. So I'm glad that you'll be actually dedicating time on that.
Yeah, sure. We need to update. I mean, that's, I think, the 3rd time now I'm speaking on crypto. And once you've found a pattern, I mean, let's follow it. So that's the purpose of today's session. So let's see how it worked out and let's see what it means. Can we know the future before it happens based on that pattern for the year to come? So that's why I want to look into it. But what an honor, I need to say that upfront first, what an honor to be in line in the lineup of speakers with Larry Williams. So it's kind of, he's a rock star in that area. So I'm just a little guy if you compare that. So it's really an honor to have that slot. Yeah.
Standing on the shoulder of giants, as he said earlier on.
Feeling like that. Yes, it's feeling like that. Okay.
Over to you, Lars.
Ron, thank you. Yeah, as introduced, I will take the next hour around to have a look at cycles within crypto and in specific Bitcoin for sure. And let me start to share. What to expect. So just let me know that audio and screen sharing is working somehow.
All good, Lars. Thank you for checking in on that.
All good. So let me continue. Yeah, what you see here already in the title. I want to talk. So the title is also around seasons. And I gave it the title because once you know when seasons start and seasons end, that's already an important cycle in a lot of things. But the seasons related to crypto do not refer to the classical seasons we might have in mind, like winter, spring, and summer. But maybe there are also seasons which relate to cyclic behavior in Bitcoin. And that's the key point. So not only looking at one specific cycle, there's also a pattern which is related on some cyclic dependencies. And we talked about that. Maybe someone is already in the group who has joined the session we did a year ago, where I featured the title, Has the Winter Ended? So this is the beginning of 2023. We had this huge rundown from, I think, 60K, 60, 70K to back to 17K. So it was a hard time for crypto and Bitcoin. And we talked about, is the winter ending? And now we need to check the question, how long might the upswing, which seems to have started since then, last? That's where seasons, cycles, can help us. So a year ago, we talked about has the winter ended? Today, we will talk about how long might the upswing last. And let me drive you through the, too quick, topics. Okay, for sure. I mean, we need to take this into account. We are doing study of cycles. This is for education, for sure. Everything can be wrong. You're on your own taking decisions, whatever out of that. This needs to be said up front. Now, why Bitcoin? And I spend a lot of time in the research on cycles within Bitcoin. And I covered this in a previous session, so I will not repeat everything here. But the interesting part, if you have a look at Bitcoin, is
I'll make a note here for you guys. In the English language, we use commas to separate thousands. So this is not 10%. All right, that's 10,000%. You see that 1.7? That's 1,700%. So he's German. So yeah, dots or periods are actually commas. All right, guys. If you're in the Anglosphere, yeah, please note that.
That we have a lot of parabolic moves seen in that asset class. If you go back to the year of 2011, yeah, where Bitcoin even traded below $1. Yeah, there have been these times. And you see in the chart then the move up to $28. This was a parabolic move. So if you compare these 5 charts here, they quite look similar, yeah, with complete different price offset points. But all these 5 charts are parabolic moves in Bitcoin. And what we're all looking for, we want to be on the left side before this parabolic move starts. Because it's crucial if you have these parabolic moves in whatever a market, if you are on the wrong side of that move, it will always come down a lot. And you see here, after that parabolic move in 2011, Bitcoin came down by over 90%, 2013 over 70%, 2014 again 90%, 2017 83%, 2021, that's where the in-sample period ends. About what we are talking about today is we had the up move into 60K, and that motivated me at that point in time to research, is there a recurring pattern? Is there a season? Is there a cycle which can help us in detecting, is this the end of a parabolic move? Yes or no? So that's why in the financial area, there you can tell 2 stories of these kind of movements. You can tell stories about people who might become rich because they have just been at the right time on the left side of that parabolic moves. And there will be maybe the same amount of stories which might have lost a fortune because they have just started the fear of FOMO topic, yeah, at the top of that point. And then this asset class came down 70, 80, 90%. This just did not happen once. It happened, I think, 5 times now in Bitcoin. So for us now moving forward, it's very important to get a timing-wise information. We are not here to predict the next price target of Bitcoin. Is it 200K, 400K, whatever? That's not the purpose why we are here or where cycles can help us, but the timing. And here it doesn't matter where the price is moving. We need to ensure from a timing perspective that we are on the right side, yeah, to the left or to the right of that parabolic move. If we are, it doesn't matter how high or high low it will go. We just need to be on the right side in regards to timing. So that's why it was so interesting to analyze all these individual parabolic moves as shown here. So the work where you will only see now a small amount in today's session is based on the research of every parabolic move since the inception of Bitcoin. So going at least where we have price data in 2010, 2009, something like that. And I did not analyze, and to follow with Larry's introduction, with the static analysis of all historical data in one lineup. I went through each parabolic move step by step and just analyzed what happened before that move, to not put too much data into the analysis. So just looking at each individual parabolic move, has there been a cyclic behavior which could be a kind of pattern at that given point in time? And as always, with the analysis of cycles, you don't know what the outcome is, and often you don't find cycles or contradicting cycles, then you could not rely on that. But for that time, there have been some interesting outcomes. And for sure, in 20 minutes or so, you will see the path for 2024, what this means now looking forward. That's why we are here. But in addition, I think it's very interesting to follow the basic principle and the idea, which also shows that it's not only just one cycle. There's often more in that cycle. So first, by analyzing all these individual parabolic moves, it has become clear that there is a 200-day nominal cycle in Bitcoin, which is always there, visible before the parabolic up move comes to an end. So not after the fact, before the fact of each parabolic up move, you could see and detect the 200-day nominal cycle. The pattern, I will come to that in a second moment, because these patterns of 5 and 3, these are the seasons. Yeah, maybe keep that in mind. If I start to talk about the patterns of count of 5 or count of 3, this is what I refer to the idea. That's the kind of season, yeah, like a summer period, how long it lasts for Bitcoin, yeah, when you have a nice sunny period or climate. So that's the count of 5. That's the summer season for Bitcoin. And then we have the count of 3, which is more or less compared to the winter season. So where it's cold and it's hard, it's tough. So that's why I compare these two kind of seasons, which seem to repeat and give you a kind of clue in what season you are in today. So, and these seasons refer to the left side or to the right side of this parabolic moves. Just for reference, if you're interested in a long deep dive into that, the session where I outlined all the research is available also on YouTube, here on our FSC channel. It was the Financial Summit in the year of 2021. The link here is seen on that chart. You can pause here, use that link, find that. There's over 1 hour just explaining what I will now compress into 5 minutes here. It's just for reference. It's published 2021. And as Larry mentioned, we now have some proof after the fact, which gives us confidence. So why 200 days? As I said, each parabolic move has been analyzed based on dynamic cycles, or what we use here is mathematical digital signal processing, Fourier derivatives of digital signal processing we can apply to price data sets. You see in the lower right is the spectrum based on the blue price line. You see in the upper left, which is the Bitcoin chart in the year of 2012, 2013. You see a peak here in the spectrum plot around 200 something. So here it's 230 days. So that's the peak we have seen in the early days of 2013. And the cycle related to this 230 days is been projecting an upswing into April, May of that year. And that's the outcome. So the light blue is here just after the fact, so which was data which was not seen by the cycle analyzer. So the predicted top in May exactly was the final parabolic up move from around 25 to over 200. Yeah, so this was the final upswing, which the 200-day cycle has seen. And there's no special interpretation. There's one peak in that spectrum here. So let's now quickly move through these kind of charts here. We can move then also forward into quickly followed up in the year of 2014, yeah, or mid 2013. You see again in the spectrum, clear peak around 200, projection of a possible peak at the end of 2013. That's the outcome. So the next parabolic upswing from around 200 up now to 1,200. Yeah, you see the light blue is out of sample, lined with the 220 days dominant cycle here in that case. And we can quickly browse through, move forward in time. This is the year of 2017 with live data. Again, you see the spectrum here in that case, 180 days. Yeah, so that's why I call there's a nominal cycle of 200 days. The real cycle for sure varies between 180, 230. So that's also the difference. If you call it a nominal cycle, it gives you just the classification, 200 days. And then at any given point in time, you need to check what's the phase and what's the current length of that cycle here. That's why the cycle analyzer is so important at each point in time. So here we have price was coming down in the year of 2017 and then projecting the key top at the end of 2017. And here, this is what happened after the fact. So with the light blue, we have seen the parabolic move into the end of 2017 based on the 180-day cycle seen in advance by the cycle scanner. So the cycle was always there in advance. Yeah, and that was then the situation we have discussed here in the year of 2022 also with another cycle at the end of 2020. We have traded around 11,000 for Bitcoin, and the upswing was projected with a length of 193 days into early 2021. And this is what happened. We moved from 11K to 60K just within that final upswing leg of this 193-day cycle. So it seems to be a 200-day cycle, which was always present there before this final up move in Bitcoin happened at each parabolic move. So yes, there is something around this nominal 200-day cycle. I mean, you know that Hurst and a lot of other early cycle experts also use nominal models on different.
So the thing is, you have to understand, cycles only do time. It doesn't do amplitude. I'll talk about amplitude if we have time tonight. I can tell you what the amplitude is. That's a different type of analysis. This cycle work does not give you amplitude. This is what I keep telling you guys. I'm trying to give you all the knowledge I've accumulated from different people. Some guy will give me my timing. Some guy will give me my amplitude, but they're two different techniques. It's not the same technique. Cycles does not give you amplitude.
And asset classes. So this is just the same idea of finding very important nominal cycles in that asset class. So the 200-day cycle is clearly one dominant nominal cycle for this asset class crypto we're talking about here. But that's more or less very simplistic, and it already helps us. If we know that there's a 200-day cycle, we can see where we are in that cycle. But you never know, will this be now the final leg of the 200-day cycle? You've seen that this cycle repeats, and it has a lot of tops and a lot of bottoms. So you never really know, will this now be the final top or the end of the parabolic move? So this is what the 200-day cycle, just as a nominal cycle, will not tell you by just looking at this cycle alone. So therefore, and it was, by the way, I did not expect this finding in analyzing these parabolic moves. And this is always why I repeat this analysis, because if you dig into the asset class and specific cycles for that asset class, sometimes you find something which is not obvious upfront or which you have not looked for as you started your cycle analysis. And this is what happened in that specific analysis here. There is a clear count which helps us to identify which of these 200-day cycle swings will now be a final up move, and which of these 200 days swings will then be the final bottom in the end. And as I said, it was not expected to see something like that. But let me walk you through, and this refers to the two seasons I'm referring to. There is one season before the parabolic up move, let's call it summer period. And there's one season after the final top appeared in this parabolic move, let's call it the winter season. And it looks like that these seasons have a defined length, which can be measured in counts of these 200-day cycle. And that's now something really interesting, which I revealed or shared with you also the first time in the year of 2021. And we now have some years after the fact to revisit if this idea also worked after the fact. And that's what makes it even more interesting today, because it looked like it worked out really interesting. But let me walk you through this count or the seasons here. So maybe not the most beautiful charts here, but they should outline the story here. We start again in the year of 2011, so 2010, as we have the first data, Bitcoin trading at some cents here. I think there was even not really, we have not been able to trade Bitcoin like we are today, but from the cyclic perspective, the cycles have been there already. So you see now with the green marked numbers or labels on that chart, the count of the repetition of the 200-day cycle, and at that point it was a 220-day cycle. And you see I've started the count here with the first 1, 2, 3, 4, 5. It appeared that at the fifth peak of that cycle, it is the end of the parabolic upswing here at around 800. So, and you see then on the right, it's that just the continuation on the time axis here. So the point in 2014, yeah, you can see it. It's the point of 5 where the final top occurs. And then I reversed the count to the bottom, just counting then the lows after that point. And you can count 1, 2, 3, also forward until the low seems to be in place. I mean, this is just one case. Yeah, it's not a pattern. I'm just looking at one case. But you can now check, okay, is this the same what happened as all these 5 parabolic moves we've seen? So let's move forward and see if this count maybe repeats. So after the 1.3 count, so that's the winter season, yeah, ends at that price level, we reverse and start to count the 1, 2, 3, 4, 5. So then the summer begins. Yeah, after the 3, that's exactly here, and then 2016. Where the cycle just continues. It has changed to 180 days. So we are aware to measure the breathing or the variation of the nominal 200-day cycle. And then we just count the summer season, which always seems to sum up of 5 repetitions of the nominal 200-day cycle. Once we arrive at the count of 5, yeah, the summer ends, or it seems like that the final peak, so the last upswing of that final peak, is then the end of the next parabolic up move here in Bitcoin, which means at the count of 5, the summer period ends, the winter period starts, and we would expect after the count of 5 another down move, which lasts possibly 3 counts if we count the lows. So in 2018 here, we have arrived at the final top of that upswing at 16K for Bitcoin. And if we move forward in time, on the left side now you see the summer period, which ended in the year of 2018. And then I switched the count again after that point in time. We use the same 200 days nominal cycle. We just count the bottoms now, 1, 2, 3. And after 3 repetitions have been completed, that's then the point where the winter season ends. We can switch back to the summer period and start again 1, 2, 3, 5 again. So, and if we do this procedure, this is what we see here. So 2019, if this would be again a repetition, then this needs to be a low point here around 35K in Bitcoin. And then the next upswing should start into to kick in which is then just on the right side of that page. You see then switching after the final leg of the 3, we switch the count to counting the summer period, which is then just the repetition 5, 1, 2, 3, 4, 5. So this would then be the expected end of the upswing, so the end of the summer season for Bitcoin. And by that point in time, 5 was the out of sample point. So because all this analysis was done early 2021, and again, the reference video is out there. I shared everything here in the FSC with the community. So this was interesting now to get proof if this seasonal behavior of the nominal 200-day cycle can help us to detect if we are on the left side of that parabolic or on the right side. I think this is an immense benefit, not just trading little swings, but if we know on which perspective, I think Larry used the word, we need to have a perspective. If this seasonality in Bitcoin helps us to have perspective, if we are before the upswing or already in the downswing, this is priceless, and we don't need to be aware of any price targets if we are that. So it has to be proven that this is truth, or if this would work, then we needed to see the final top in Bitcoin in summer 2021. So after publishing this analysis, because we had the discussion, after that Bitcoin came down from 70K, okay, will it now continue to go down? And after that analysis, I told you here, we need to see a final upswing into September before the next winter period, so downswing starts. And if we talk about winter, Bitcoin always corrected around 70 to 80% after the 0.5. So we are not talking about small swings here. We are talking about an immense upswing and then a loss of 70 to 80% in that asset class during the winter period. So these are immense moves here. So everything now, which happened after that point in time, is out of sample for this analysis. And we have now the proof, and let me walk you through the proof, what happened afterwards. So the summary is, and watch the reference video for more details on each of these parabolic move. The expected top for the final up leg in Bitcoin could be projected by the 5th repetition of the nominal 200-day cycle. And it's always seen 3 to 6 months ahead of time in the cycle analyzer. You know, the 200-day cycle is just the nominal cycle. It could be something between 180 to 220 days, which you need to measure at any given point in time. After this count to 5. Count to 5 sounds too mathematical, so therefore let's call it after the summer period. When summer ends, after count 5, Bitcoin always lost 70 to 90%. I mean, we are not here to do price projections, but we need to know that summer and winter are very heavy and different periods for the price action. So after that point in time, the expected low, so the end of the winter period, was always aligned with the 3rd repetition of this nominal 200-day cycle, which, if you measure that by time, is always between 1 year and 3 months, between 1 year and 6 months after the top came in. You could expect the bottom or the winter period, the winter season, to end. So that was the finding at that point in time. That was why this video ended also with, we would expect another up move into counter 5. And then, and that's not just another up move, then this upswing is completed, game over, 70% down move afterwards. You will lose everything if you're not getting out at that point in time, or if you invest now in this final upswing and you stay in, you will lose 70 to 80%. So it's not about just projecting another up move or down move here. I summarized everything already, so you don't need that slide here. So now let's look what happened afterwards, and then I will switch over to what this means for this year. So that was the projection at that given point in time. Now just looking at the price chart. At the bottom, you see the nominal 200-day cycle just visualized by these little cyclic chart here, and this was our summit. So I meant we need to see a final top around summer, which is in
Yeah, so I mean, this is why most of these October streams, Eric, all these are just going to be long form. When we start doing November, it's going to be very condensed, very quick. And I'm just going to look through all this content I made in October. I'll start telling Portia the clip, but essentially I'm going to have to see what I need to explain more further in detail, or what I got to improve in my explanation. So, and a lot of things I'm just going to repeat over and over again. And what, like the presentation I'm showing you here, this is actually state of the art stuff. So this stuff is a vast improvement over the simplified way things were done before, right? You saw that. Oh, we just look at the decennial pattern. We just look at years ending in 1, 2, 3, 4. This is way ahead of what people were doing before. All this stuff is new. And I think, this is, if these guys keep improving, I'm going to keep donating to these guys. And if this dude keeps working on his improvement of the past knowledge, because like a lot of this stuff is so old school, very arcane, but it's also restricted in the sense that this was before the time of advanced computers and advanced knowledge. Because now, like, you can take all this stuff, analyze it in real time. We have so much data now, actually, than before. Before, it was so hard to get even good stock data. Like, a lot of times they didn't even have the open, close, or high and low of each day. Most of the stocks before the 1950s, they only had closing price. So that's why, now we have so much more information. We have high level of computer processing. And you got people like Lars here, who's like, he's an engineer by training like me, but he's really interested in using those techniques to advance cycle analysis. It's just shit. You know what? We are entering a new era. And this is why we want to get an edge. So a lot of people, they're going to poo-poo trading because a lot of people understand the fact that you are at a disadvantage as a small investor, small trader. You have the lack of knowledge. You have the inability to trade in real time because you are not next door to the New York Stock Exchange. A lot of these things are against you. You have no edge against the big boys. But you see now, we have people independently trying to figure out markets in a way that probably are never discussed anymore. Cycle analysis, these things. This is more like astrology. And that's why I'm telling you, astrology used to be the domain of very wealthy people because they try to understand the cycles, So you got this extra help here, I think will definitely benefit you in investing and even in trading. But we are right at the beginning, the forefront. So this is all experimental, okay? And we're applying it to Bitcoin right now.
Alignment with this cycle here in the future. This is what happened, and not only happened that we have seen the final peak, which was,
well, boom, he was right, wasn't he? He had 1, 2, 3, 4, 5 cycles. The 5th cycle was the final high, and it dropped. So if you look at all his videos in the past, you can see he predicted that. I think it's worthwhile to study this stuff. So
it's higher at the given point, and 4 here. Afterwards, the winter kicked in as before, and Bitcoin dropped around 80%. So that's, again, the parabolic move. You need to be careful. If you have invested at this final up leg here, and you have not been aware of that, you have lost everything afterwards anyhow. So yeah, the 5 worked. The pattern of 5, the summer period, worked again. So now the next proof was to be discussed 1 year ago. No, in January 2023, we have met here again. We have discussed Bitcoin. I repeated that cycle. So if something works, it just works. We don't need to find other cycles. If stuff works, it just works. So, and it even more validates the power of cycles. Once you have found working patterns, stick to that. So at that point in time where the winter period, now when does the winter end? So at the January 2023, I mean, the whole cryptocurrency had this headache and was worried about, okay, Bitcoin is over, game over. It will never go up again. And the question, the $1 million question, we called it at that point in time, was when will the crypto winter end? Yeah, and we just had to look at our seasonal cycles in the asset class, which have been there. So there's proof that it was there. We never know if it will repeat again, but we have some analysis which could help us on that decision making. So, and as said, we are not here to do price predictions. It's about when does the next parabolic move maybe start? When does it end? How long might it last? And then we have perspective. That's not final timing. That's not where you can derive your trade entry and trade exit. And I'm sure Jake will tell us more during the next days how to build this up into a complete trading system. This is just a perspective. This is just a window of opportunity. Yeah, January 2023, this video is also there in the public cyclic archive now, so it's always there for your review. I went out and told you change is coming, and this was the chart I showed you here. And maybe if you know, have in mind what I told you before, this cycle is much more important than just looking at this single cycle. This is the 200-day cycle, at that point in time, 213 days. But what was more important of that chart here, please count the lows starting in the year of 2021. So the early low is the start of the winter season. So this was number one. Count number one was January 2021, the low. The second low was then of that cycle somewhere, I think, September 2022. Count number two. So now count number three was exactly May 2023. That's why I had a lot of confidence based on that cyclic analysis that this winter, this downswing, which was already 70, we have moved down from 70K down to, yeah, you see it here, 17K. So we have come down 80% again. And I went out in January. Now it's the best time between now, January until May, yeah, to build up your long position into the next upswing. Because again, if this pattern repeats, this would have been the point in time. So the final downswing of this cycle here until May will then conclude into the end of the winter for Bitcoin. And this will be the start of the next summer period, which lasts then another 5 repetitions of the 200-day cycle. Yeah, just look on the chart here. I mean, today.
Right, there we go. So now you got it. 1, 2, 3, 4, 5 cycles. Top. 1, 2, 3, winter bottom. Now we're going into 1, 2, 3, 4, 5, right? So this next move in Bitcoin should be very interesting. If it aligns with the elections and it aligns with the hype I'm seeing with AI, I'm expecting this next one is going to be crazy. But, you know, I don't think it'll be primarily in Bitcoin. I think you got to look at those altcoins. What altcoins are going to be following the crypto summer here? We are entering a very, very interesting time, I think. So I'll show you this other video. So this is an update over the summer. So remember, this video that I just showed was in January. Now I'm going to show you something from this summer, which is an update. Okay, let me find the video. Blah, blah, blah. Gotta get more organized, man. All right. Let's go here.
Summit.
So this is in the summer now. This is in
Let's
June.
fast forward, and that's why you're all here to today, June 2021. I have prepared, I call it main charts, because I will show you much more today than just this cycles model. I mean, it would be quite boring just to repeat what I did in 2021. So let's add a little bit more to the mix, in addition to never change a running system. It's quite easy. So here you have everything in front of you. So maybe now it's time to make a screenshot for everyone out there. That's the key chart for the next 30 minutes. And I will walk you through step by step. So within the next 20 to 30 minutes, you will get a complete understanding of what you see here. But there's a lot on here. And let's start and I will walk you through step by step. And at the end, I will come to the conclusion. So don't get confused right now. Please follow me. Follow me, relax, take your beer, coffee, whatever. Just listen and watch for the next 20 minutes to get a clue. The first topic I want to explain is this gray, looks like a zigzag line here on the chart, which is a composite cycle model. It's just plotted as just connecting the tops and bottoms from that composite model. And I will switch to that composite model first. What is that composite model about? And hey, Lars, you told us about the 200-day cycle. Why are you now showing a composite model? And what is this zigzag line, which then continues into the future, which is the composite plot about? Okay, so let me explain that first, and then we get back to the chart. This zigzag plot line is the dynamic cycles model. It's just based on 2 cycles, but it is mainly the 200 nominal day cycle model, nothing different. Let me tell you why. This is the spectrum analysis from today's Bitcoin price chart. I have just zoomed into the spectrum view of the analysis. But if you would pull up Bitcoin daily price in our cycle analyzer at today's point in time, you would see that spectrum here on the screen. And if you know how to read a spectrum, we are looking now for the key peaks here in that spectrum. And the key peaks, if they follow certain measures, are then called what we call the dominant cycle. And these kind of dominant cycles are then used to point into the future or do a projection with that dominant cycle. So, however, what we would look out for is, about the nominal 200-day cycle, which would be here, this dotted line or where my cursor is. So we don't have a clear peak on a 200-day cycle. We would have to choose maybe a shorter one or maybe a slightly longer one. And even this is not satisfying opportunity here, because we have 2 other even bigger or more dominant cycles at the current point in time. So that's why we need to spend some time to digest this spectrum and how to work with that. But there's something, if we spend some time looking at that spectrum, you would see that the most dominant cycle without any historical knowledge about would be this one, which has the highest amplitude, a clear peak, a green triangle, a big triangle. And if you read here in the table view, this would also be picked by what we call AI or Copilot, which helps us in identifying the most dominant cycle. If you don't have any knowledge how to read the spectrum, this is the ranking mechanism we provide here, which is 375 days. This is exactly this cycle here, which is currently the most dominant one. So this is not the nominal 200-day cycle we would expect or we quite need if we want to continue that framework, that pattern, or if we expect that pattern to repeat. But if you do the math, so now divide 375 by 2, where do you arrive? Someone putting in the result?
375 divided by 2. Can't hear you.
We're polling them now, and hopefully we'll get a response soon.
Okay. I will wait.
Richard has just shared his insight, along with Ed.
Okay, what's your finding?
So we have a range of 187.5 from Richard, 200 day from Ed and AO. AO is saying close to 200, and then also suggesting the harmonic relationship, which is key.
Yes, so I mean, for sure, that's where we are. So divided by 2, you would arrive at approximately, not exactly, but the 186. Yeah, is what I call the harmonic relation divided by 2, or the harmonic relation of 2 would give us exactly the 186 days cycle, which is not listed here. So this is exactly this peak here, which is not the most prominent one if we just want to spot one. But this is the harmonic relation to this dominant cycle. So again, here we have the nominal 200-day cycle, which is still there. It's not so obvious to spot because here it is shown in the harmonic relation of 2, which then reveals as the most dominant cycle with an length of 375. But I would call it's again the 200 days nominal cycle in its current form. So today's form, I mean, we deal with dynamic cycles. They are never static. So where the child is 186 and the parent maybe a 375, but they both relate to the nominal 200-day cycle. And that's why I have picked or chosen these 2 cycles now to create the composite model, because I think I would not pick the 278 because I stick with the most important one. So there's no individual judgment here. I go with the most dominant one, but then I add the harmonic relation because I know from historical analysis from each important market top and bottom that the 200-day cycle was always the most important one to follow. Call it persistence, call it historical knowledge. So this is the kind of additional information you would have to use as a cycle analyst. But anyhow, I'm not diverging here from the path how to choose a cycle. So that's just upfront. So, and if you now do the composite plot based on these 2 cycles here, so 375 and 186, again, I hope you got it, which is still the normal 200-day cycle model. This is the composite plot you get here.
So you see that we gonna have another big move into 2025 at the beginning. So I think probably crypto will rise from December to April. I mean, I wrote it from the 2023 to 2024 using the Bitcoin miners like Mara, CLSK, you know, and if you did options on them, those were like 1,000% up moves. You know, that's why you got to time this shit. Don't be shooting your shot when it's not ready.
In a cycle form or cycle shape. And if you would measure the distance, so to be honest, there's still the 186-day cycle here, because the big swings here, yeah, this is related to the 375. But if you just connect or measure the distance here from that top to that top, from that top to that top, or from that low to that low, or to that low to that low, the main rhythm is the 183. So the phases are not so divergent that they cancel out each other or that they would form a crazy shape with these 2 cycles. You clearly see the both rhythms which at one specific point they just add up from the amplitude point of view, but the key swings in regards to timing have the main rhythm of the 186. So we spot the main rhythm of the 186 days. So it's also seen here in that high. So the timing is perfect even from that, and we don't care about the amplitude fit here. It's the timing of these cyclic rhythm here, and you see the subharmonics of it. The key cycle still, if you check all turns, are related to the 186, not the 300 ones. So okay, we are here in that cycle. So this is where we are today. So we might face a challenging summer period. So this is just looking at that cycles model, and then another upswing into early 2025, or even maybe there is an interim peak here somewhere late summer and then early 2025. But however, don't see these cyclic swings in isolation, because we need to apply the count of 3 and the count of 5 to check, okay, was this top here, was this already the final peak of that move? Or do we expect another high or additional highs to follow in Bitcoin before we might maybe see a correction of, again, 80% or something like that? And therefore, we apply the count of 3 and the count of 5, which is not seen here on the chart, but I will come to that in a second. I just want to explain, this is the composite model I use on that chart, just connecting as zigzag lines on the price chart, because we are just interested in timing and not the cycle shape, and just using the 200-day cycle. So let's get back to the price chart. So this zigzag line here, which you see, is exactly that cycle model you just saw, derived from our cycle scanner, which I showed here, the summer bearish period, and then the key top expected early 2025. I hope now you understand where the cycle model is coming from. Now let's apply the count of 1, 2, 3, 1, 2, 3, 4, 5. And I've done this here. So these indicate the key 200-day cycle. The red one here is the nominal 200-day cycle, so the ideal cycle. I just kept it, and this was also the original chart I showed the past years. However, as we deal with dynamic cycles, you need to adjust it to the current dominant cycle. And this is 186. And I hope you got why I choose 186 now, because the key swings on price are based on that harmonic subcycle, not the 375. It is still the nominal 200-day cycle. And it is aligned by the, so I have aligned this 1, 2, 3. This is the low. So you align it here at the at the key top, and then you count the first bottom, second bottom, third bottom. So that this is why we have the timing. By the way, that was also why I told early 2023 this is the end. And now let's count the tops. So this is the first top here. This is the second top here of that cycle, and this is the third top. So we are currently at the third repetition of that top. And if this pattern will continue, we need to have 2 more repetitions of that cycle. So, and I've indicated this here at the bottom. So count 4 is still up to be expected. Count 5 is also still up to be expected from timing. So, and this count 5 is exactly the timing projection now, early 2025. So, and in these kind of parabolic moves, trading these interim cycles here, or even this negative cyclic situation here, I mean, who wanted to short NVIDIA in the past year, even though there might be downswing periods? So the key takeaway just on the cyclic model is that the upswing, the summer, the good times, the music will play until early 2025. So yeah, maybe there's a hangover in between. We need to take a pause until the party can continue the next day. But I don't know how to time that. The key reading from the dynamic cycles is this pattern, never change the running system, might continue into early 2025. So this is still intact. It helped us timing the top, timing the bottom. I don't know when this will break, but for now I would call it valid and in action. So now you got the zigzag line, the cycles model, the count of 5. This is how I would see it now. Now let's explain the other topics you see here on.
So let's see if this is going to be true. I mean, we have a minor high, which I think in this chart, if you can't read it, is Halloween. So we'll have a minor new high in Bitcoin in Halloween. Then we'll drop again into November. So around elections and all that, right? Then we'll start moving to the next major high into April 2025. So let's see. If this is true, what's the price? That's what everyone's worried about. We got the timing, but we don't have the price. What is the price? So let me do my analysis here. We do point and figure charting. I've explained a little bit about point and figure charting, but I didn't go into details about it, and I don't think I will. I'm just going to keep referring you to stockcharts.tv, how to do point and figure charting. But if we do the analysis here, let's see how high Bitcoin can go. So if you bought the lows during the Sam Bankman-Fried scare, you used the techniques of point and figure charting, you would have got the right target. Now, this is a log scale. Okay, I'm using percentages. I'm not using the traditional way of doing point and figure. So you're going to just have to believe me. I'm not going to explain how I did this. I got 7 boxes here, 7 columns, 3 box reversal, 5 percentage scale. Okay, so 1.05 to the power of 21. 7 times 3 is 21. I got a factor of 2.786, blah, blah, blah. If I use that, I take the bottom of this region to the top of this region. So this square is my accumulation. I project that Bitcoin can go from a range of 138,000 to 185,000. So a lot of people are saying like, what, 200,000 is a good range? I don't know. 1 million? I don't know. Let's just keep it cool here. Let's just say over April, I'm just going to say Bitcoin can go to about that level. So we're near an intermediate top. I mean, it could still go down in Halloween, right? If the market is going to drop, I'm sure Bitcoin will drop as well. So let's go over some Wyckofian explanation of what Bitcoin might do. This might be of interest to you.
This is a complex trading range that suggests 3 stages. Stage number 1, which is the reaccumulations phase, still predominantly bullish structure, but that demand is weakening, which leads us to the second stage. That stage of the structure is going to be associated with the increased volatility. And then we are going into the third final stage, and that is of the reaccumulation. Here, we usually would have an aggressive rally up into the highs, and then we're going to have lowering of volatility. Once volatility comes down through the testing period, we're going to have some kind of...
All right, screenshot this. This is what they think Bitcoin is going to do. So we're going to have another new low. We're going to have a reduced volatility. And then after that, Bitcoin's ready to launch. So look around the time of Halloween into elections. I'm sure it's going to match up with how the S&P 500 is going to do. So I am going to tell you, if you're interested in point and figure charting, like how I did there, you guys should go over here. Okay. Go to Stock Charts TV on YouTube, search point and figure. If you do that, you will see like a lot of examples of how to do point and figure charting. And I think that this is how you determine where the price will go. It's really I'm just going to put it on the website here. You guys, I repeated this over and over again, but you guys should just know it by now. Go to Stock Charts TV. Go to Point and Figure and look for Bruce Fraser. All right. There's the white guy over here. That's his face. Look for all the videos with Bruce Fraser. Once you find it, study it. This is how you determine where price will go. And if you don't believe me, here, just look at how he determined price way back when. In June of 2023, I believe. So let's
turn my attention here to the zone of this NASDAQ 100 stocks above their 50-day moving average. Just a really good breadth indicator, and we can put it right on the bottom of this chart and follow it. And you can see that we are looking for really two attributes of this indicator. One is directionality. We want to see whether it is rising or falling. If it's rising, we generally say that breadth is getting better. It's confirming the upward trend in the index. When the trend is falling, it says that we have a general diminishment of breadth. It's a negative condition. Most stocks are in falling mode, and we want to go with the primary direction of the breadth. In this case, I want to make the point that the high that was made in August a year ago here, and I've actually put this green shaded bar across this zone, is in the vicinity of 90% of stocks are above their 50-day moving average. Very, very positive bullish breadth. Here in December, we hit over 80%, and then we had a divergent characteristic note. So we have a high, we have a higher high in the index, a lower high in the 50-day moving average of breadth. And you can see that then following that, a downward stride, which takes us into the low that was made at the end of the year. This is a rather positive, not a divergence really, because both of these are higher, but it really demonstrates that stocks are starting to get in gear for higher prices. So
this is like, I'll just give you a taste here. They analyze charts very in depth, and that's why it's like you guys really got to up your game. You guys are not doing things the right way when you're just like blah 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 blathering, and this is why you need so much more knowledge. And now I'm just gonna skip ahead to where we do the point and figure chart. So all right, see, I mean, this is why you guys need to know this stuff. Like, you can't even do normal charts well. Let's see if you can even handle point and figure charting.
On some of the other indicators we like to look at, such as seasonality. Here is the S&P 500. Note the accumulation structure that formed in 2022 into 23. And I have three counts here to work with for us to pay attention to. And let's get my little pen handy here. This is the accumulation area. This first count, which is 9 columns, and this is a backup of sorts at this zone to 3850. This counts 4850 to 5200. Well, right now we're only at 4400, and we're just above that resistance zone at 4300. We actually have some really nice point and figure work that pointed to this area as an objective range. We finally hit it. But this count here takes us to the highs of the bull market back in 2021. And that would be a major achievement for the S&P, but a long way away from here, and making the point that the S&P is lagging the NASDAQ 100 by a substantial margin so far. And so here we see that the larger count goes all the way up to 6,350, 6,700. I would suspect if we can fulfill that count, but this is all in that accumulation that formed here in this zone in 2022. If this forms and can get to this level, we probably need a reaccumulation pause somewhere in the zone of the prior highs from 2021. And we have a ways to go just to get to that level. So something to watch. Now, special note, and that is that if we look at this area right here, this is a little swing count. And the swing count is takes us up to 4550. Close to that now, 4400 was the high touch here. 4550 is the swing count, and that would be, I think, a natural area to stop, look, and listen, because there's some resistance in this zone right here. And so we will watch that resistance area to see if we can get to that level. And then finally, just as a side note, of interest is that I did a point figure count of the distribution area using this 3-box method. This is 50-point scaling, and this count here, and we always want to be very careful and conservative in our point figure counts, especially so with distribution counts. And so we take this area, counts down to 3450 from the high. We were within 1 box of fulfilling that count objective range at the lows that were made last fall. And so pretty darn good. There is a larger count here, may come into play later on, but for the moment, we have fulfilled a very important count to this zone and worked quite nicely. And we have talked about these distribution counts in the past. Finally, last chart, this is the S&P vertical chart. This is the whole accumulation zone. We've looked at this a number of times in the past. And so these notes here, I like to keep my notes on the chart because that helps me to recall the key things I was thinking at the time that I was assembling the chart as we go. Now this chart, I just constantly keep adding to it over time. So when we had that original preliminary support and selling climax, I'm labeling that at the time that it happened. I'm seeing these big gaps. I showed you these at the time and said, this looks climactic to me. Well, in fact, this did prove to be the important low, selling climax. And then this was key resistance. Also, this upthrusting action at the August peak also is an important resistance area, and we've upthrusted it right here. The point I would like to make now is to go down and look at the 50-day moving average breadth indicator, stocks above the 50.
So this video was made in around June of 2023. You see the targets here. Conservative target is between 4850 to 5200 on the S&P 500. The longer count goes up to 6,350 and 6,700. So let's look at what the chart shows now, right? Look at what the chart shows now. So if this was a prediction made then, back in June of 2023, see how it goes now. I mean, it looks pretty damn fair, right? So he said 4850 to 52,000. We reached it in March of 2024. So this prediction was made in June of 2023 when the S&P was at around 5,200. So a year later, close to a year later, we've made that target. Now we're in a new range here. We're about 5,700. So 5,750 as of Friday's close. I don't think anything's going on right now in futures market. Futures market's about the same. We're only down about 0.07%. So nothing there. We'll see how it goes. But eventually we'll hit 6,000 and up. And I think that's the beginning of that bubble that we've talked about. So anyhow, we'll see you guys tomorrow, hopefully. It's the end of this session. I didn't have a lesson today, but I'll probably continue the lesson from last stream, talking about how to look at candles and things. I'll continue that. I think covering simpler things over and over again is more valuable. Maybe we'll talk about moving averages again, but yeah, let's look at Chinese markets actually. China's doing pretty well still. Yeah, about 2% up. We broke in through the resistance. Let's see. China's still very bullish. Exceedingly so. So still not a time to try to short that thing. Beware. If you really think you can get this thing shorted at the right point in time, good luck to you. This thing is in bubble territory. You don't know when it ends. It's just how many shorts are left. Also, I still got to cover the quartz, North Carolina quartz mining stuff. Oh, yeah. Definitely something important. I think also it's going to be part of my series on semiconductors. Definitely got to talk about semiconductors. I think there's a lot of misinformation out there. Got to clear that up. But overall, have a good night. I'll see you tomorrow. Yeah. I think Ride tried to come up here, but yeah, we don't have open panels on this stream usually, Ride. I have to get through all my content. I think maybe once we start going to November, we'll have more Q&A. I mean, it's already about 3 hours. It's already way too late. I'm not going to be talking to anybody anytime soon. Let's see how Bitcoin's doing. I think Bitcoin was rallying. This is probably the extended move I'm looking for. It kind of faded a little bit. It's still stuck below that resistance. Natural gas, I'm still got to worry about this sucker. Tomorrow, let's see. We're still in that resistance range. I don't know. Very irritating. Got to be more patient about it, I guess. So we'll see. We'll see how things go tomorrow. The only thing we got to worry about this week will be Thursday and Friday inflation reports. We'll get CPI and PPI. So that's the only thing we got to worry about. Economic calendar. So I don't think anything's interesting there except those two. But we'll look over the world calendar. Let's see. Yeah, Japanese, nothing there. French. Yeah, Australia, nothing interesting. Canada here. Australia again. Yeah, Germany. So Wednesday. All right, I got to change the time zone. I'm Pacific time. You got most of it. I'll just set it to Eastern time. All right. So 2 p.m. FOMC minutes. So that means the meeting minutes from last month's meeting will be released. It's usually a time if the Fed needs to massage their messaging, they'll change it. So if they'll do it, they'll change it there. You got the 10-year note auction, 10-year Treasury note auction on 1 p.m. Eastern. Then we have core inflation rate, CPI, at 8:30 on Thursday, 8:30 a.m. So that's 1 hour before the open. And then Friday, we'll have our PPI at 8:30 a.m. And then 10 a.m., Michigan consumer sentiment. So those usually are the most important things for the week. So Thursday, Friday, usually. Maybe something will happen Wednesday, maybe not. I would assume there will be a nothing burger on Wednesday, so no worries there. If you're conservative, I would probably sell any pump into CPI on Thursday. Just sell. If you're a risk taker, keep your positions. Hold it through the rest of October. Good luck to you. As you know, as I said, sell on Rosh Hashanah, sell Jewish New Year's. Jewish New Year's is already done last week. And buy back in Sukkot. Sukkot is in 2 weeks. Okay? You still got 2 weeks to buy your stuff back. Probably over 2 weeks, actually. Probably on the 22nd of October. So expect something to happen then. But all right, we're in the third hour almost complete. I'll see you guys tomorrow.
GetCRACK. Wake up, motherfucker.